Welcome to this video on the topic of cash flow statements. These are important documents because they show the ability of a business to pay its immediate debts. It's an important document for a variety of reasons, and we will look over those in the course of the class. There are several reasons why a cash flow problem may arise in the first place. For example, it's generally the case that production takes place prior to sales. We make the thing now and sell it in the next time period. The gap in between making it and selling it means there's a shortage of funds. The resources to make the product have to be committed now, workers have to be paid, overheads have to be met, and yet the receipts from the product, from selling the product on the market, will not arise until the next time period. That gap is crucial, and if that gap is not managed properly, the business could go out of business, it could go bankrupt. In many sectors also there are seasonal demands for products. I suppose the most obvious one here would be Christmas cards or Christmas items. Let's say in the Christmas card business, Christmas cards are demanded once a year. So you'd expect a surge in demand around Christmas time and very little afterwards. Now I know the companies who make Christmas cards will have diversified and make other cards for other occasions or whatever. But you can still imagine the costs of producing Christmas cards and then waiting for the sales to occur so that the revenues can flow in. So it could generate a cash flow problem. Generally speaking, there is a lag between the sale of goods and the receipt of the cash. That's the point. It's also an important document when negotiating with the bank, perhaps for an overdraft. Banks need to know that the business can survive in the short run. It can pay its bills in the short run. So it needs to see some sort of estimate of cash flow, and it needs to have confidence in that cash flow statement, or perhaps otherwise the bank wouldn't advance the request. It is possible for a profitable business to have a problem with a shortage of money. Many people don't seem to understand this, but a very profitable business still has to make the product in one time period and sell it in the next. It generates a lot of profit as a consequence, perhaps, but the gap between production and sales is still an issue, and it still must be addressed. So it may be the case that a successful business may not be able to pay its bills because of the timing of the receipts and the obligations to make payments to the resources, to the workers, buy the machinery, overheads, utilities, and so on. A cash flow statement focuses attention directly on the most critical aspects of short-term financial management. It focuses in on the day-to-day handling issues, the day-to-day issues that involve cash. So it's a very nitty-gritty statement. It's a very fundamental statement. The statement entails making detailed estimates of when the cash will be received, and when sales will be made, and when cash will have to be paid out to the resource suppliers, to the workers, and so on. So many items will be fairly regular. I mean, the workers get paid perhaps every week or every month, whatever the contract states. The utilities, the gas, the electricity, or whatever's been used, those bills perhaps come in every 3 months. But the sales may be large or small in the next time period. It's difficult to estimate precisely what the cash flow predicament of the business is. The statements themselves are prepared on a fairly regular basis, and the reason for that is that the organization needs to have the facility to meet its obligations, and it needs to plan ahead. So it needs to facilitate the daily transactions. and it must ensure that the cash is available to cover its obligations on a day-to-day basis. The organisation will also want to avoid having excess cash. If cash is lying idle in the bank, it's not working. So it needs to recycle it, perhaps to reinvest or to expand the business, or it needs to consider carefully any idle cash. So excess supplies of cash are also an issue that the business wants to look into. Now, here's an example of cash flow statement for a fictitious company, ABC Limited. It looks like, I suppose, like all accountancy statements. It looks fairly formidable, but in fact it's very simple. I'll put the cursor onto the screen. Okay, here we have the cash budget. So it's running from January, February, March, April, May, June. Here are the receipts, the cash sales, and receipts from debtors. So the total receipts from sales, 200 plus 800 in January, 1000. Now, the payments, well, the stock used up, labour, the workers, rent, perhaps, loan repayments, there might be some obligation there, services or utilities, say electricity. So the total payments, when you add it up, comes to, in this case, 740. Now, net cash flow is the receipts minus the payments, which is 260. Well, in January, the business might have been running for some time, so it may have an opening balance in the bank, let's assume 150. So if you add 150 to the 260, we get 410. That's what's in the bank at the end of January, 410. Now, do it again for February. Sales, the sales have dropped here. The debtors, again, sales have dropped, so it's down from 1000 to 700. Stocks, use more stock. Labour slightly less, rent's the same, loan repayments slightly down, services slightly up, total payments 700, cash flow, well in this case we break even on the month. The receipts and the payments are equal. Now we started the month with 410, so we put that as a starting balance, and the closing balance will be 410 because we didn't make any money and we didn't lose any money in February. Next one is March. We go 80, 630 when we add it up, and down here we have 740, so we have a loss of 110. Now we started the month with a bank at 410 here. We take away what we lost, leaving us 300 in the bank, which of course will be our opening balance in April. So you get the idea of how the cash flow statement is worked out. It's actually a very simple statement, but in a real business situation we'll have many receipts, many different categories. We'll have many different types of payments. Some of them will be zero and some will be large in particular time periods, and so on and so on. So what we've got is quite a complex picture of the income and payments of the business and their effects on the bank, effects on the bank, on the company's ability to pay. So if you look, as I said here, March, April, May. So in March the payments were bigger than the receipts. In May there was a loss, and in April, so there's May 190, April 60, and March 110. So losses in those months. It's important to make explicit, to make clear all of the assumptions behind the cash flow. That's an essential requirement. Okay, that concludes this talk on cash flow statement. Thank you for watching.